Welcome, everyone, to another episode of Smart Investing Insights. Today we're diving into a crucial topic that can make or break your financial future: strategies for diversifying your investment portfolio. If you've ever wondered why putting all your eggs in one basket is a bad idea, stick around, because by the end of this video, you'll have practical tips to spread your risks and potentially boost your returns. Let's get started. First off, what exactly is diversification? It's the practice of spreading your investments across various assets to reduce risk. Think of it like this: if one investment tanks, others might hold steady or even grow, cushioning the blow. But how do you do it effectively? Let's break it down step by step. Start with asset allocation, the foundation of any diversified portfolio. Don't just pour everything into stocks, mix it up with bonds, real estate, commodities, or even cash equivalents. For example, stocks offer high growth potential but come with volatility, while bonds provide stability and regular income. A common rule of thumb: aim for a balance based on your age and risk tolerance. If you're young and aggressive, maybe 70% stocks and 30% bonds. As you get older, shift toward more conservative options. Remember, this isn't one size fits all. Consult a financial advisor to tailor it to you. Next, consider geographic diversification. Why limit yourself to your home country? Investing globally can protect against local economic downturns. For instance, if the U.S. market slumps, emerging markets in Asia or Europe might thrive. ETFs like the Vanguard Total International Stock ETF make this easy. They give you exposure to thousands of companies worldwide without the hassle of picking individual stocks. Just be mindful of currency risks and geopolitical events. They can add an extra layer of unpredictability. Now, let's talk sectors and industries. Even within stocks, don't bet everything on tech giants like Apple or Amazon. Spread across healthcare, energy, consumer goods, and finance. Why? Because sectors rise and fall at different times. During a pandemic, tech and healthcare might soar, while travel and hospitality suffer. Tools like sector-specific mutual funds can help here. Think of the Fidelity Select Technology Fund for targeted exposure, balanced with others in different areas. Another key strategy: incorporate alternative investments. These go beyond traditional stocks and bonds. Real estate through REITs, real estate investment trusts, can generate rental income and appreciate over time. Commodities like gold or oil act as a hedge against inflation. And don't overlook peer-to-peer lending or even cryptocurrencies, though those are higher risk. The goal? Add assets that don't move in lockstep with the stock market, creating a smoother ride overall. Rebalancing is your secret weapon to maintain diversification. Over time, some investments outperform others, skewing your portfolio. Say stocks surge and now make up 80% instead of your target 60%. Periodically, maybe once a year, sell winners and buy underperformers to reset the balance. This enforces discipline: buy low, sell high. Apps like Wealthfront or Betterment automate this, making it effortless. Of course, diversification isn't foolproof. It reduces risk but doesn't eliminate it. And over-diversifying, that can dilute returns and rack up fees. Aim for 20 to 30 holdings in a stock portfolio, or use broad index funds for simplicity. Always factor in your goals: saving for retirement? Go long-term. Need quick cash? Keep it liquid. In summary, diversifying your portfolio through smart asset allocation, geographic spread, sector variety, alternatives, and regular rebalancing can help you weather market storms and grow your wealth steadily. It's not about getting rich quick. It's about building resilience. If you found this helpful, hit that like button, subscribe for more investing tips, and drop a comment below. What's your favorite diversification strategy? Thanks for watching, and remember, invest wisely! See you next time.